I just so happen to have two slides ready. This one's particularly exciting. This one is shopping centre yields, prime shopping centre yields in Europe. And the red bar is where the prime shopping centre yield got to at the top of the last cycle for those particular countries. So probably for most countries that was either 2006 or 2007, and that's represented by the red bar. And then the green bar shows you where the yields have got to, I think it's as at second quarter 2014. So generally probably by now there's already been a little bit of movement, generally in a downwards direction in those markets, but that's where it's at quarter two 2014. And I thought it was just interesting to put that comparison up, and you can see on the left-hand side of the chart, there's a whole bunch of countries where the prime yield has already got to the level that it was at the peak of the market last cycle. And you remember, what a peak that was. There was a massive amount of trading going on, very competitive environment, and we're already in a whole bunch of markets at that sort of level. Then there's some markets in the middle there, which you can see where the yield is starting to approach that level. And then you've got quite a widespread of markets on the right-hand side where the yield is currently still considerably above where the peak was last time. And one of the things the panel might want to discuss is in that range of markets, if it's likely that the yield compression will have come down to the same extent, or whether there are circumstances in those markets which mean it won't. And one of the interesting things is, the yield on any property, it partially should reflect the opportunity cost of money. We know that. But also it should reflect the growth prospects for that income stream, right? So if the yield is low, then you would be expecting that income stream to grow considerably. And what is interesting is that back in 2006, 2007, in most of the European markets, we had quite strong rental growth prospects. So in Spain, in 2006, we were expecting 6% per annum rental growth in shopping centres. Now we've got yields coming down to a similar level, and we don't have rental growth. Okay, even in Germany, the sort of powerhouse of Europe, we're talking about very, very weak underlying rental growth in the market. So again, that might be something that the guys and girls here want to discuss as to how they're getting performance out of these shopping centres from those starting levels of yields. Maybe, Richard, you could just move me on to the next slide.
I certainly could.
And this slide is comparing the comparison country by country with the shopping centre yield compared to the government bond for that particular country. And I think the takeaway on this is that the light green being the current situation and the dark green being the situation at the peak of the last cycle, the takeaway on that is clearly that whilst yields are again low and coming down, there is a huge margin to your opportunity cost, which is the government bond rate in those markets. So maybe after all, we shouldn't be so scared about where the yields are getting to. Perhaps we just need to accept that yields in property are lower than they used to be.